Palantir has just reported its earnings, and they are truly staggering. As a cutting-edge technology company, Palantir has been making headlines for its innovative solutions and partnerships with both government and commercial organizations. In this video, we'll take a closer look at their financial performance and what it means for investors. But I don't want to waste your time, so let's go ahead and dive right in. Palantir works with many different types of businesses and organizations, including government agencies, financial institutions, and big companies. Their goal is to help these organizations make better decisions by giving them a better understanding of the information that they have. They do this by bringing together different types of data and making it easier to see the big picture. And on Monday, the company reported their Q4 earnings, and there were definitely some shocking numbers. Palantir now has cash of $2.6 billion with no debt and an undrawn credit limit of $950 million. This suggests that the company's stock is relatively secure and it is unlikely to go to zero. This gives shareholders peace of mind, not just due to the large cash reserves, but also because the company is poised to take advantage of any opportunities that may arise in the current economic climate. Also, Palantir is holding a substantial amount of cash even as other companies are losing money. With current assets 5 times greater than current liabilities, Palantir has the ability to pay off its debts in the next year. Additionally, the company has the financial flexibility to continue investing in growth as it expands into new markets. Finally, Palantir's $2.6 billion in cash is more than 3 times its total liabilities, meaning it could pay off all its debts immediately if they chose to. So Palantir's financial position appears to be strong. Let's take a closer look at dilution as a potential concern. Year over year, there has been a significant decrease in stock-based compensation. In Q3 2020, when the company went public, stock-based compensation was $849 million, but in Q4 2022, it was only $129 million. Over the past 6 quarters, the company has been decreasing stock-based compensation each quarter, with a 27% decrease from 2021 to 2022. And unless you believe that Palantir's products won't generate billions in the future, dilution shouldn't be a concern. As long as the company doesn't escalate stock-based compensation in 2023, dilution shouldn't be a significant issue. And I think there is definitely proof that these products are working. For example, in 2022, the company's software delivered a remarkable outcome. It delivered $200 million in return to Tyson Foods and helped companies get through the energy crisis. The CEO, Alex Karp of Palantir, credited the success to the fact that they have built software that actually works and not just software that's easy to sell. The company has released a new product called Foundry 23, which is a significant part of their product strategy moving forward. Foundry 23 is based on the idea of making businesses easier to understand and control with computers. The management team explained that while businesses can be controlled by computers, it's not always straightforward. A special tool called an ontology is needed to link the insights that people have with the programming that the computer can understand. So now that we've talked about the products, let's dive into Palantir's growth. This is a crucial aspect that many investors are closely monitoring. The company actually grew 24% over the past year, which did beat analyst estimates. Despite a sluggish government revenue in early 2022, Palantir's commercial revenue growth saw a steep decline in Q4 compared to the first half of the year. Their international commercial business is seeing growth, with a multi-million-dollar long-term partnership with Crisis 24 and a $50 million 5-year expansion of their work with Sompo Holdings. In the government sector, they've seen growth across the board, generating $293 million in revenue in the past quarter, including a major agreement with Defence Digital in the UK worth up to £75 million. It's important to keep in mind that government revenue is highly volatile and can fluctuate greatly quarter over quarter. Yet the recent news of new and expanding government contracts is a positive sign. On the other hand, the current economic environment has resulted in tighter capital spending, which may affect Palantir's commercial revenue. But the company continues to form new strategic partnerships across diverse sectors such as Cloudflare, Tampa General Hospital, Integrity Tool and Mold, and Crisis 24, which bodes well for its commercial growth. In fact, Palantir's growth rate of over 20% even during an economic recession is remarkable. If the company can grow at this pace during tough times, it's not difficult to imagine how much it could grow when businesses have more capital to spend. And Alex Karp said in the earnings report that he suspects that their commercial business will grow north of 40%. Plus, with Palantir only having 15% of the top 1,000 companies buying their product, they have plenty of room to grow. As the world moves towards greater reliance on data analysis areas and artificial intelligence, Palantir's products will continue to be in demand and drive its growth for the years to come, unless there is a dramatic shift away from these technologies, which I highly doubt. With an adjusted gross margin of 82%, Palantir has proven to be an efficient business with the potential for greater cash flow in the future. The company has consistently grown its gross profit, which indicates that its revenue is outpacing its cost of revenue. The recent earnings report showed numerous companies benefiting from Palantir's products and renewing their deals, which showcases the product's stickiness and its ability to command a premium price. As a leader in the AI software platform space and with continued positive results for its customers, Palantir is poised to grow both its revenues and margins. The future looks promising for Palantir as more and more companies recognize the value of its products such as Foundry. The next few years will be critical in determining the product's success with existing customers. So finally, we look at the company's profitability. This is very important for investors, especially during tough economic times. As I've said in previous videos, there are two ways to measure profitability: net income and free cash flow. I usually use net income when just looking at companies and making predictions, but if I want a more deep analysis or I already have money invested in the company, free cash flow is more important in my opinion. And right now, Palantir's free cash flow yield is low. However, their high margins suggest that they can increase their free cash flow in the future. We can see that their operating losses have been getting better every quarter, but we will have to wait and see how much of that will turn into free cash flow. For Palantir to get more earnings and free cash flow, they need to keep making more money while keeping their costs for selling and running the business low. We may not see big changes in their free cash flow this year, but in the next few years, I think we will see more free cash flow and continued growth in revenue. However, this is a historic quarter for Palantir, as they have finally achieved profitability according to generally accepted accounting principles or GAAP measures. This was made possible by their strong financial performance, careful management of employee stock-based compensation, being careful with their cash, reducing losses from the investments, and the successful acquisition of their joint venture in Japan. And the company is expected to be profitable for the entire year, which is several years ahead of their original goal. When I think about the future of Palantir's products and partnerships in 5 years, I believe the company will be much more successful than it is right now. I think they will be well established and their current customers will still be using their products. And Palantir also plans to continue introducing new products which will have a positive impact on the company. In a tough economic environment, many big companies have succeeded by taking advantage of new opportunities. Palantir has a substantial amount of cash, no debt, and a product that the US government and many other companies have already found to be very effective. So I think they will be able to grab any opportunities that come over the next few years. So for me, I'm still buying more shares of Palantir, but only a little bit at a time because I already have a lot of money invested in the company. I want to make sure that I have enough money to invest in other big companies too, which if you want to see the companies I'm buying right now, click here. Hope you all enjoyed this video and I'll see you in the next one.